I am not a tax professional or CPA. This information is for educational purposes only. Always consult a qualified financial advisor or tax professional regarding your specific situation. Quick disclaimer before we start. I'm not a CPA or a tax advisor. Nothing in this video is personal financial advice. This is a breakdown of publicly known strategies for educational purposes only. Talk to a licensed professional before you make any decisions with your own money. Every few months, a headline goes viral. This billionaire paid less in taxes than a teacher. And the internet loses it. People assume it means the rich are hiding money offshore, breaking the law, gaming some secret loophole. Here's the uncomfortable truth. They're not hiding anything. They're reading the same tax code you have access to and using it exactly the way it was written. No secrets, no crimes, just a completely different relationship with income. And today we're breaking down exactly what that means. The core concept, saving versus optimizing. Before we get into Musk and Buffett, we need to separate two ideas people constantly confuse: saving taxes and optimizing taxes. Saving taxes is short-term. It's the guy telling you to write off your dog as a guard animal for your home office. It's aggressive, it's often illegal, and it usually collapses the moment an audit happens. It's a trick. Optimizing taxes is different. It's not about paying zero. It's about controlling when and how income becomes taxable over decades, using structures the tax code was intentionally built to encourage. Retirement accounts, long-term capital gains, business depreciation, these aren't loopholes. Congress wrote them on purpose to push specific behavior: saving for retirement, long-term investing, building businesses. The rich don't have a secret code. They just play a longer game than save this tax season. The Warren Buffett approach: buy and hold. Warren Buffett's Berkshire Hathaway stock is worth well over $100 billion. On paper, he is one of the richest people alive. But most of that number isn't income in the eyes of the IRS. It's an unrealized gain. Here's the math in plain terms. If you buy a stock for $10,000 and it grows to $1 million, you don't owe the IRS a single dollar on that growth, as long as you don't sell. It's not income yet. It's just a number on a screen. The tax event only happens at the moment of the sale, called realizing the gain. Buffett has held some of his core positions, like Coca-Cola, for over 30 years. He isn't trading in and out chasing quarterly gains. Every year he doesn't sell is a year he owes the government nothing on that growth. That's not a trick. That's literally how the tax code defines income. And Buffett has said publicly for years that this asymmetry, where his secretary can pay a higher effective tax rate than he does, is a structural feature of the code, not a secret maneuver. The lesson isn't never sell. It's this: taxes are triggered by transactions, not by wealth. The Elon Musk approach: borrow, don't sell. So if selling stock creates a tax bill, how do people like Elon Musk afford homes, jets, and lifestyles worth hundreds of millions without a massive salary? The answer is a strategy nicknamed buy, borrow, die. Musk has famously taken a $1 salary from Tesla for years. Instead of paying himself in cash, which would be taxed as ordinary income at the highest bracket, his wealth stays in stock. When he needs cash, instead of selling shares and triggering a taxable gain, he borrows against the stock as collateral, the same way you might take out a loan against your house. Here's why that matters. Loans are not income. You don't pay tax on money you borrow because you're contractually obligated to pay it back. It's a liability, not earnings. The bank gets interest. Musk gets liquid cash. The IRS gets nothing because on paper, no income event occurred. This isn't unique to billionaires, by the way. It's the same basic logic as a home equity line of credit, borrowing against an asset you already own instead of liquidating it. The difference is just scale and the type of asset used as collateral. Lessons for the average person. Now, you and I don't have a stock portfolio we can pledge as loan collateral to a private bank next week. So what actually transfers from this? 3 principles. 1. Time is the biggest tax advantage you have access to. The tax code rewards patience over speed. If you hold an investment for more than 1 year, it typically qualifies for long-term capital gains rates, which are significantly lower than short-term rates or ordinary income tax. High-frequency trading, chasing meme stocks, day trading in and out. Every one of those short-term wins gets taxed at your highest bracket. Buffett's do-nothing strategy isn't laziness. It's tax efficiency by design. 2. Use the accounts the government already built for you. 401k, IRAs, HSAs. These exist because Congress wants to encourage long-term saving, the same impulse behind Buffett's buy-and-hold approach. Contributing to these accounts is the retail version of optimizing, not saving. It's not a hack. It's literally what the account was designed for. 3. Stop trying to beat the tax man. That's the wrong goal entirely. This is the mindset shift. Musk and Buffett aren't evading taxes. They are sequencing when a taxable event happens, and they're doing it over decades, not tax seasons. The average person chasing a secret trick to pay 0 taxes this year is playing an entirely different, and usually much riskier, game than what these two are actually doing. The goal was never to avoid taxes forever. The goal is to control the timeline on your own terms. So here's a question for you. What's the biggest financial myth you've heard that turned out to be completely false when you actually looked into it? Drop it in the comments. I read every single one, and the best answers might end up in a future video. If this broke down something you always wondered about, subscribe. $Sense drops a new one every week. And remember, I'm not a tax advisor. Talk to a real one before making moves with your own money. See you in the next one.